the title of this webinar is Return. The fundamental objective of any investment planning is to generate a commensurate rate of return on one's portfolio. Right? Now, as I said, that if you are looking in terms of rate of return, right, each investor would have a target rate of return. Depending on his stage or requirements, right, there is a particular rate of return which will be in line with his age, income, or particular status, and on the basis of that, he would address those asset classes and those particular securities which will be able to give him that rate of return. Though of course there is nothing definite, but on the basis of historical performance, right, one can identify particular classes of assets and particular securities which are likely to give him that rate of return. Right? Now, when I say rate of return, obviously, as I said, the rate of return is dependent on two elements. One is the capital appreciation, and second is the periodic income that one is getting. If you are looking at variable investment, which is equity, right, the focus is usually more on the capital appreciation. Whereas if you are looking at fixed income investment, the focus is more on the regular form, which is in terms of interest that one gets on your investment, because the capital appreciation is normally very little of the total rate of return. One expects more in terms of regular return that one gets on investment, whereas in equity you would expect more of capital appreciation, though dividends are also an important element of the rate of return. Now, for example, if I were looking in terms of rate of return, now there is in fixed income securities, one is able to clearly identify that, okay, this is the rate of return that I am getting, because whatever is the interest rate that is quoted on the particular security, one would get that amount of rate of return. Of course, if it's a hybrid or a variable fixed income security, so to that extent there will be some variation, but one can still identify that this is the particular rate of return that one is getting. Now, whereas if one is looking at equity, then in terms of equity, then the problem becomes a little bit more difficult, simply because you need to identify securities which will give you a particular rate of return. Right? Now, it is not exactly definite that this security will give you that rate of return. Right? So, you need to construct the profile of securities and identify that historically this particular security is giving you this rate of return, right? And in a particular scenario, right, depending on the risk profile, this is the rate of return that one should generate. So you compare that this is the possible rate of return that one gets, and then you compare it with the actual rate of return which the security is giving. So if you find that the expected rate of return is currently more than what the price is quoting, then in that case you buy the security, right? Now, for example, to take an example is, suppose on the basis of whatever risk profile, you feel that the intrinsic price of the security should be, let's say, 55 rupees, right? Now, if the current market price of that security is, let's say, 50 rupees, then it is underpriced, which means that it was possible that this will give you a rate of return which is, more than what is its required rate of return. But on the other hand, if the current market price of the security is already 60, then obviously it means overpriced, right? So the whole task of fundamental analysis, which we say in investment analysis, is in terms of trying to find underpriced securities, right? And how do you find out whether they are underpricing or it is based on the basis of their risk profile. For example, any security should have depending on the risk, there is a certain amount of return that is expected. So, if you know that, let's say, this is the amount of risk, then this is the minimum rate of return that I would like on that particular security, right? So, on that basis of required rate of return, you find out that this is the price at which I should buy it for. If the current market price is less than it, then yes, you do have some hope of rate of return. But on the other hand, if the current market price is more than what the intrinsic price will be, then it is possibly not a good idea to buy the security because it is overpriced. Right? Very frequently, if you read newspaper columns or you listen to some of the investment broadcast or investment recommendation managers, so there will be some recommendation that this is buy or sell or hold, right? That if it is overpriced or underpriced. So the whole element in terms of investment analysis is in terms of trying to locate underpriced and overpriced securities, right? Now, in terms of calculating the rate of return, as I said, right, a simple way of doing it is simply finding out the capital appreciation, right, and also the regular income and dividing it by the initial price, and you would get the rate of return, right? That is, let's say, price at the end minus price at the beginning, right, plus whatever is the regular income divided by the initial price, right? Now, many times what happens is, suppose let's say I bought a particular security, let's say 2002, and I sold it in 2007. Now, if I look at 2002, I bought it let's say 100, and in 2007, right, the price was let's say 200, right? So I would have said that okay, 100 was the total amount of capital appreciation. Plus, let's say I'm assuming that I had got some dividends over the years, and if I add up the total dividends, let's say over the last 5 years, so let's say another 100. I bought it at 100, so this is 200 divided by 100, right, into 100, right, that's a 200% over 5 years, right. On an average, this is 40%, right. Now, this possibly is the rate of return on your investment, because you bought it at 100 and you sold it for 200. But if I am really trying to figure out what is the annual rate of return on the price of the security, right, then this situation does not work out, simply because there may be a lot of variations, right. You might have sold it at 200 at a particular point in time. 15 days earlier, right, the price of the security maybe have been 190 or maybe 150, right, or it could have been 225 as well, right. So at different points of time, the price of the security is likely to vary, right. So this may be a holding period rate of return, right, that is 100 plus 100 divided by 100. But in terms of actually the rate of return on the security, one needs to calculate it in terms of, ending price and beginning price over a particular period of time, right. So for example, let's assume, right, that let's say you have got a price of security at ₹50, right. In that particular year, you got a dividend of ₹5. Next year, it became 60, right. Then in that next year, let's say 2002, you got it, right. 2006, 2007, right. Then you got 8, then 72, then you got it at 2, right. Then it again came down to 55, right, and then you got only 4, right, then 62, right, then 8, and then finally you sold it at 75, right. Now if I look at this particular performance of this particular stock, right, so I would have to compute the rate of return over each of the years, right. So in this case, it would have been 60 minus 50, that is 10, plus 5 divided by 50, that is 15 divided by 50 into 100, that is 30%, right. Similarly, this would have been 72 minus 60 plus 8 divided by 60, that is 12 plus 8, 20, divided by 60, that is 33.33%. Then 55 minus 72 plus 2 divided by 72. So now this is a negative rate of return. So this is 2 minus 7, 17 minus 17 plus 2. This will be 15 divided by 72, right? So this would come out to be something like this is 18, this is 25, right? So 6, 5, 125, 5, 6. This is something like minus 22 point something, right? Similarly, I would calculate the rates of return for each of these years, right? And each of these years would have been an annual rate of return. Now, if I want to find out the arithmetic average, that is the average rate of return, what I would do is, total all these years rates of returns divided by the number of observations that I would have, and I would get the arithmetic average, which is a more relevant measure in terms of calculating the rate of return on a particular security, especially over a long period of time, right? Now, here in this case, I have calculated annual rates, you could calculate it monthly, you would calculate it even daily, right? Now, in most cases, over when the period of observation is long, right, arithmetic average is a reasonably good measure to use. The problem comes when you have too much of volatility in the prices of the securities. Now, for example, assuming, right, that let's say you start with the price of security which is 100, then it goes down to 50, and then it goes down to 100. Now, if you look at in terms of the price, have you got a rate of return? The answer is no, right? But in terms of, if I calculated in terms of arithmetic average, this would have been minus 50, right? 100 minus 50, 50 minus 100 is minus 50 divided by 100, so that is minus 50%, right? And this is again 50 divided by 50, 100, this is 50%, right, 100%. If I take out the average of this, right, this will be 25%, right? Now, the arithmetic average is coming as 25%, but actually, have I earned 25%? No, I have not. In this case, then geometric average is a much better measure to take instead of arithmetic average. Now, how do you calculate arithmetic average? I will calculate arithmetic average, right? What I can simply do is, right, there are two ways to look at it. Either, for example, if I look at these figures, right, what I could do is simply, this is 30%, 30 divided by 100 plus 1, this will become 1.30. Similarly, this will be 33.33 divided by 100 plus 1, which is again 1.33. Now, either this, I do it this way, I calculate the rates of return in percentage, divide by 100 plus 1, so I would calculate that. Or what I can do is ending value plus whatever dividends that I get divided by beginning value, right? So if I look at the first one, right, the big ending value is 60 plus the dividends is 5 divided by 50. So this is 65 divided by 50, right, 200, right? So this is 1.30, right? Now, what I would do in this, suppose, let's say, assuming that I have, let's say, 3 observations, right? So what I would do is 1.30 into 1.33 into, this is minus 22, so this becomes 0.88. I multiply this. Since there are 3 observations, find the under root of 1 by 3, right? Whatever observation or whatever I get out of that, minus 1 into 100, I will get the geometric rate of return, right? So, geometric rate of return is far more accurate than arithmetic average. But if you have a large number of observations, it really does not matter whether you are taking geometric average or arithmetic average, simply because over a long period of time, the volatility in any case comes down. So, practically there is no difference between arithmetic average and geometric average. Over short periods of time, and if the volatility is higher, then the geometric average is always a better idea. But if you always compare geometric average and arithmetic average, you will find that if you take the geometric average, the average will be much lesser, which will be lesser than arithmetic average, right? But if the volatility is more, the difference will be more. But if the volatility is less, the difference is only going to be marginal. But in most respect, in terms of security analysis and fundamental analysis, since we normally take larger periods of time, so one normally sticks to arithmetic average.